All right, let's talk about the one thing that stands between a tiny, manageable loss and, well, total account destruction. It's the stop loss. And today, we're going to master it. Because let's be real, without one, you're not actually trading. You're just one bad decision away from a complete disaster. So, this isn't some made up scary story. It's a real life account of a trader who was doing everything right. I mean, he was profitable, disciplined, consistent for months. But then he got a little complacent, placed one single trade without a stop, and boom. In just a few minutes, a surprise news event completely wiped out 5 months of his hard work. Gone. Just like that. And that right there, that single moment, that one bad decision, that's the difference between having a long career in trading and just being a cautionary tale for everyone else. See, a stop loss isn't really about managing this one trade. It's about making sure you have capital left to trade tomorrow and the day after that. Okay, let's be crystal clear about this. The second you enter a trade without knowing exactly where you'll get out if it goes wrong, you've stopped trading. You're just gambling. And you know what they say, right? The house always wins in the end. It literally just takes one trade, one moment where you think, I've got this, to blow up your entire account. So this has to be your rule number one, your unbreakable, non-negotiable law of survival in the markets. Seriously, before you even dream about profits, you have to burn this into your brain. Every single trade must have a stop loss. No exceptions, ever. Okay, so how do you actually set a stop loss the right way? Well, it all starts with a huge mental shift. You have to stop thinking of it as just some random exit point. A stop loss is something very specific. It's the exact price on the chart where your brilliant trade idea is proven to be, well, wrong. And this really shows the difference in thinking, right? The amateur approach is just picking a number out of thin air. I'll risk 50 pips. But the professional, they ask a totally different, much smarter question. Where is my idea invalidated? See the difference? One is based on a random number. The other is based on actual market structure. It's moving from gambling to strategy. So what does that mean in practice? It means you use the market's own map. If you're going long, buying, you're betting that the price will bounce off a support level. So where does your stop go? Just below that support. If the price breaks through it, hey, your idea was wrong. Simple. And if you're shorting or selling, your stop goes right above that resistance level. If it breaks above, you get the picture, your idea was invalidated. Now here's a little pro tip for you, and this is a big one. You gotta remember, the big players and their algorithms, they know exactly where everyone puts their stops, right at those obvious levels. And sometimes they'll push the price just enough to trigger all those stops. It's called a stop hunt. So what do? Just add a small buffer, maybe 5 or 10 pips beyond that level. It's like hiding your stop just outside the main target zone, giving your trade a way better chance of survival. But just looking at structure isn't the whole story. You also have to think about volatility, how much the market is swinging around. A 50 pip stop might be perfect on a slow, quiet day. But during a big news announcement, that same stop is going to get taken out instantly. That's where a tool called the ATR, or average true range, comes in. It basically measures the market's recent wobble and helps you set a stop that's actually appropriate for what's happening right now. It adapts so you don't have to guess. All right, so far, we've been all about defense, right? Playing goalie and preventing those huge account-killing losses. But here's the cool part. A stop loss can also be a powerful offensive weapon. You can actually use it to lock in your profits as a trade starts working for you. I want you to think about it like you're climbing a mountain. As you make your way up, you keep moving your safety rope up to a new, higher anchor point. That's your trailing stop. Now, if you slip, you don't fall all the way back to the bottom of the mountain, right? You just fall to your last anchor point. We're doing the exact same thing with our trades. We're locking in our progress. So, there are basically 3 common ways to do this. First is a fixed trail. Super simple. Your stop just follows the price at a set distance, say 30 pips. The downside? A normal little pullback can knock you out. Second, you've got a structure trail. This one's a bit smarter. As the price makes a new high and then pulls back, you move your stop just underneath that new little valley. It gives the trade more room to move, but you might give back a bit more profit if it reverses hard. And finally, my favorite, moving to break even. This is a huge psychological win. Once your trade is in profit by the same amount you risked, you just slide your stop loss right up to your entry price. And just like that, you have a completely risk-free trade. You can just let it run. Okay, knowing what to do is great. But honestly, knowing what not to do is probably even more important. So let's talk about the 5 cardinal sins of stop losses. These are the traps that so many traders fall into, and you need to avoid them like the plague.
Sin number 1. This is the big one, the absolute deadliest. Never move your stop further away once a trade is going against you. Think about it. Your stop was your I'm wrong point. Moving it is basically saying, okay, I was wrong, and now I'm willing to be even more wrong and lose more money. No, just take the small, planned loss and live to fight another day.
Sin number 2, falling for those big, shiny round numbers. Placing your stop right at 1.1000 or 1.2500. You might as well paint a giant red target on it. Everyone does it, and the algorithms know it. Those levels are magnets for stop hunts. Be smarter than that. Put it at 1.0995 or something just off the mark. You're basically hiding in plain sight. All right, sin number 3 is just pure laziness. The one-size-fits-all stop. Look, every currency pair, every market has its own personality, its own rhythm. Using the same 50-pip stop on everything is like wearing a parka to the beach. It makes no sense. You've got to tailor your stop to the specific conditions of that trade on that day. Number 4. Oh, this one is so tempting. It's the I'll just remove it this one time trap. Don't do it. That's not trading. That's crossing your fingers and hoping for the best. The market couldn't care less that it's just this once. And Murphy's Law for traders says that the one time you break your rule will be the one time the market decides to flash crash and take your entire account with it. And finally, sin number 5, setting your stops too tight. I know, it sounds counterintuitive. We want small losses, right? Of course, but a trade needs a little bit of room to breathe. The market wiggles, it ebbs and flows. If you're getting stopped out constantly by just the normal market noise, it means your stop is literally strangling your trade before it even has a chance to work. And all of this really leads to the ultimate, most dangerous trap of all. It's that little voice in your head that says, nah, it's okay, I'll just watch it. That phrase is poison. It's just an excuse for not having a plan. Because what happens when that trade goes deep into the red? You're going to hesitate. You're going to hope. You might even freeze. A hard stop order takes all of that emotion out of the equation. It's your bodyguard, protecting you from yourself. So let's just nail down the key takeaways here. Number 1, every single trade gets a stop. Period. Non-negotiable. 2, base your stops on market structure, that I'm wrong point, not just some random number of pips. 3, use tools like the ATR to adapt to how wild the market is. 4, trail your stops to protect those hard-earned profits. And 5, always use a real stop-loss order. Don't just watch it. Look, at the end of the day, using a stop-loss isn't about trying to avoid losses altogether. Losses are part of the game. It's about making damn sure those losses are small enough that you can show up and trade again tomorrow. So I'll just leave you with this one question to think about. On your very next trade, is your capital actually protected?